Welcome back, Mobile Home Park Nation. Ferd here again with another episode of the Mobile Home Park Lawyer Podcast. My guest today, special treat for you guys. He's a big-time mobile home park owner-operator. He's also just launched an Opportunity Zone Fund, which is focusing on mobile home parks in Opportunity Zones. He's raised capital. He's got a good team. Please welcome Sam Hales of the Saratoga Group. Sam, how are you?
Ferd, man, that introduction, I just feel super important, super special. Hey, good to be with you.
You're the only guy. You're the only guy I know that is doing both a combination of MH, raising the fund, and in the OZ. So definitely want to hear about that today. But also just want to get to know you better. We know each other a little bit already, obviously, but want to get to know you a little bit more for our audience, your background. I'm going to ask you all kinds of stuff on the market and everything. But tell us a little bit more how you got to where you're at now.
Awesome. So I launched Saratoga Group back in 2011, and originally we were buying single-family homes, mostly in Northern California, kind of a buy-to-rent model, like a lot of people were doing back then. We actually raised money from China for that fund, which was interesting in many ways. So did that for quite a few years, and what happens with single-family? It's like you start getting enough of them, and you've either really got to go big to scale it, and you got to build all the systems, or you figure out, which is what we did, man, that's a lot of work. I think I want to do something else.
Right.
And so I the Waypoint and Blackstone with Treehouse, and I mean, I can appreciate what those guys have built, because I know just how difficult it would kind of get those systems together and scale that. So we did that for a number of years, and then we're just kind of looking for the next thing. I mean, the other thing that happened is home prices went up so much that it was just kind of that buy to rent and kind of that dividend or cash flow yield. The numbers just weren't making sense anymore, at least in the target markets we had. So we kind of bounced around for a couple of years, did some development, did some land entitlement, just very opportunistic. Bought an office building, bought some other kind of commercial, just dabbled in a few things, but really trying to find the next business that we could really focus on. And then finally, like end of 2016, early 2017, started finding out about mobile home parks, and just, man, the lights started to go. I mean, I listened to probably 150 podcasts. So
Wow.
What we're doing right now, I really appreciate it, because I was the guy who on the weekend when I was, doing a home project or whatever, man, I was just streaming nonstop, and I just couldn't get enough of it. And I appreciate, the content that was put out there. So anyway, so that kind of, the light bulb went on for me, and we started getting into mobile home parks. We started buying in 2017, and we now have 44 communities. And we're in 10 different states, and we've got more in the pipeline. So
that's great, man. That's
kind of the journey.
Definitely fast growth, and I'm with you, man. Where it's the single family stuff, I was doing that, not to your scale, I'm sure, but I was doing single family, and I'm like, this is going to be a hustle that you got to keep hustling. Like it's going to be hard to own 100 houses by myself. I could own 2 50-unit apartment complexes. It seemed like, but those were priced differently. So the margins were higher on single family. But I'm like, you start getting a big number. I'm like, man, do I want to own 100 or 1,000? That's a lot of toilets. Maybe I should look at something else. And like you, kind of drank the Kool-Aid on the MH, and it's been great. And so you guys are doing great things. So tell me did your fund change when you were at Saratoga doing single family to now you're doing MH as far as your capital raise with 44 communities? I assume that's not all your personal savings account, right? You've got a lot of other financial partners on your team. I'm interested to hear how you got that structured.
Yeah, so we've kind of done two approaches, and Ferd, we've done maybe the more traditional, where we find the assets and then we go raise capital specifically for those assets. In many ways, I like that better, because there's definition around, hey, here's what you're investing in, and I think investors generally like that better as well. But once we started getting into opportunity zones, there was another kind of nuance there for the investor, where they have a timeline, right? So they've got 180 days after their capital gains event to get the money invested in an OZ fund. So there are all these timelines that we were balancing. It's like, there's no way to do this without a fund. Because once the money comes into the fund, they've met their timeline, then the fund has its own timelines, but then we can kind of space it out with the acquisitions that we're working on and the budgets for the improvements and all that sort of stuff. So that's when we started launching funds at Saratoga Group, and we're on our third Opportunity Zone fund now.
Wow, that's great. So on the funds, when the investor puts their money in, let's say I put in $1 million today, do you always have a project in the pipeline where you got a place to put that, or do you have a week, a month, 6 months where I've got essentially cash drag where my money is just sitting there, making zero? Maybe you've made commitments to pay me some sort of preferred return, but for you guys, you're in the hole. Then how do you balance that? Because I feel like that's one of the challenges a lot of people face versus you find the asset, you do a private placement memorandum, you raise capital for that one asset, you close it, and you've got a budget with a pro forma and assumptions, and like look, you're going to buy this many pads, there's the occupancy, boom, 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 and it's as you said, definite or finite. How do you balance that on the kind of blanket fund, if you will?
Yeah, no, you're right. It's absolutely a balance. On our last OZ fund, we raised 16 million, and there's two problems for the sponsor. One of them is you get the money too early. It's like you said, there's a cash drag there. We pay a pref once the money hits our account. And then the other problem is you get the money too late. Well, that's kind of a worse problem, right? I mean, yeah, because then you're like, oh crap.
Yeah.
So we're okay with bringing money in a little bit early. We want to have confidence that we have the projects in the pipeline, right? So we're not going to take. So for example, this new fund is a target $30 million raise, but we're not going to take all the money before the end of the year. What's happening because of a number of factors, a lot of interest in kind of placing money before January 1st. Right. But we don't have enough in the pipeline yet to take more than about 18 million is kind of what we're targeting before December 31st. And so other folks, we're probably gonna have to push out, and hopefully, right? Hopefully we get the 18 million before the end of the year. But point being, for us, it's kind of a range. I mean, we could take as little as probably 7 just to cover the properties we're buying before the end of the year in the new fund, and then as much as 18. And we have some wiggle room there, but it is a balance, yeah, because you don't want to take it too early, and you don't want to take it too late.
Got it. Now on let's use 18 million for an example. Then I'm sure you guys are only bringing in accredited investors, and I know different people have different opinions on. Would you rather, as I'm asking you, would you rather have 18 $1 million investors or 2 $9 million investors, or maybe 36 $500,000 investors? Obviously, the more people calling, they want to talk to you. You're the boss. The more people calling you with your cell phone, but at the same time, the big guy with 9 million may have the keys to your house. If he's like, you need me. So would you have a preference on that, or how have you guys tackled that?
Yeah, it's a really good question. So I'll give you an example. Our last fund, our last Opportunity Zone fund, raised 16 million. We have 170 investors.
Oh, wow. Okay.
Now, that scares the bejeebies out of my CFO, Becky, right?
I bet. Your K1s are a mess. Your CPA bills.
Yeah, but at the same time, and Ferd, you know this about us, we embrace technology, right? So 5 years ago, we white labeled the CrowdStreet platform for our business. So we use that to automate all the reporting, distributions, everything through CrowdStreet, and it doesn't feel like 170 investors. I mean, we have people still want some personal touch, and so, for example, later today we're doing our quarterly investor call for that fund, and there'll probably be 30, 40 people that chime in there, and then we record it and distribute it to everybody. But anyway, as far as your question, I don't know that I have a strong preference, but you're right. If somebody's coming in and they're they represent a large portion of that fund or even all of that fund, then they're going to, it's less about you saying, hey, here's the terms. It's more them saying, hey, here's the terms, right?
Right.
So, so we've had those opportunities a number of times for people that are like, wanted to put money with us, but also wanted to dictate the terms. And we've generally chosen not to do that.
Makes sense. And I know you mentioned earlier here that, that your love for podcasts and the resources. I know when I started looking at real estate 12, 13 years ago, I felt like the resources out there were limited, not just podcasts, but like I was trying to learn. I had my finance degree, my MBA, but they didn't teach us the discounted cash flow analysis in graduate school. Like I had to go learn it on my own and learn really not just IRR on Excel, but literally learn the machinations of all these financial metrics. So I appreciate the data out there as well, and guys like you kind of open up the tent. So my next question, you're not prepared for this, so you can tell me no, but are you going to open up the tent even more and say, here's how our model works? We do an 8 pref and a 30/70 promote not, or it depends on the deal, or is that, I know like you've got your technology system that's kind of proprietary. Is that kind of your special sauce and you don't want to share that with a larger audience, or is it pretty much this is industry standard, quasi plain Jane, we're just better operators or better capital raisers, and it's not special sauce as much as operational sauce?
I'm happy to share that, Ferd. I really don't. I appreciate when other people share with me, and so I feel I guess they call it the abundance mentality. But we've had a lot of people that have shared with us, and we're always happy to share. So yeah, our Opportunity Zone Fund is set up with a 7 pref, and then it's a 70-30 split up to a second pref, and then it goes 50-50. And I know if somebody has only invested in, let's say, multifamily real estate syndications, they're going to hear that and be like, man, that's expensive. If they've invested in other MH syndications, they'll probably say, hey, that sounds like a good deal.
Right.
At the end of the day, I think most astute investors understand this. It's way less about the split you're getting, and it's way more about who you're investing with. The deal is important for sure. As you know, Ferd, I mean, our business is, especially what we're buying, it's all, roll up the sleeves, jump in and like fix it. And so the operation is so critical, and we could miss slightly on the asset, I think. But if we operate it well, we'll make up for it. So it's like I tell people that MH is more like running a business than managing real estate, right?
I agree, and I even argued that on my tax returns with the CPA. I said, look, I'm buying Goodwill, I'm buying going concern. Now I'm buying physical land, I'm buying land improvements. Sometimes I'm buying mobile homes or other personal property. But I'm also buying some Goodwill. I said, I've got a park I'm filing a tax appeal right now, but it's 20 acres, like 20 acres of dirt in this town. At 10,000 acres, worth $200,000. I paid $1.4 million. So either I overpaid and I'm the dumbest guy around, or I think I bought more than dirt. In fact, this isn't even virgin dirt. This has got utilities and concrete and stuff in the way that's not reusable. So I'm buying the business from a tax perspective, but really it's because it's not mailbox money. I used to do triple net retail stuff. You get a Walgreens, it's checks in the mail, right? Okay. Yeah. This is different. And I think that's where a lot of investors come in. And it's frustrating to me a little bit because I'm trying to buy in the space, and I see guys that think it's like Walgreens. They say, man, Walgreens is a 4 cap. This is a 6. I'm going to buy this. And I'm like, you shouldn't pay 6. That's like 8.5.
Yeah. Right.
They'll find it out later. And it's too late.
Yeah.
But it cost me a good opportunity on the buy side. But maybe they'll hire me as a lawyer to fix it.
There you go. Yeah. Playing both ends of that. That's good, Ferd.
Hey, trying to help, man. Got to feed the kids, right?
Absolutely.
Let me ask you. You obviously understand opportunity zones quite a bit. I've not done a lot of OZ. I had 18 acres in OZ. We were doing apartments on a few years back. but I ended up getting out of that partnership. So I didn't really go through the full OZ fund myself.
Yeah.
I know that I have a pretty good feel for the general tax benefits relative to non-OZ. Can you give our listeners the kind of Reader's Digest version of what those benefits are and how they can impact your after-tax yield?
Yeah, absolutely. And obviously, I'm not a tax professional, right? But I've spent a lot of time around it at this point, so I can definitely share what I understand. So there's kind of three benefits. The initial one is that you get to defer your capital gains tax. So when it first rolled out, well, actually the end timeline hasn't changed. It's through the end of 2026 that you get to not pay those capital gains taxes, right? So, let's say you sold $1 million of Amazon stock, or maybe you sold it for $3 million. Your cost basis was $2 million. Anyway, you got $1 million of capital gains. One thing that's important to understand: you don't have to invest, like a 1031 exchange. That's what we're all used to in the real estate world. You got to invest everything, right? You can't really take anything off the table. In this case, you only have to invest the capital gains. So that example, the $3 million and $1 million was profit. You just have to invest the profit. The $2 million you can take off the table and do whatever you want. So that's the first thing, is that you get to defer paying those capital gains. So it's like a interest-free loan from the government, so to speak. The second thing, it's kind of a slight advantage, is you get to step up your basis. At this point, through the end of, and see, here's where I may or may not be right on this. I actually think the next step, which is a 10% step up, is good through the end of 2021. I'd have to verify that. And then after that, it just goes to 5%. But anyway, so you get to shield a little bit of that, right? You get the interest-free loan. That's the first advantage. Then you get a little bit of shielding. The third one, which is really the main advantage, is that whatever profit is inside of the opportunity zone fund, when that fund liquidates, that's tax-free, right? So if they invest that $1 million and it turns into $2 million,
all two is free. All two is free. Right?
Exactly. That's all.
And you have to leave it in. You have to leave it in for, was it 7 years, or 7 year and a 10-year kind of burn off of that?
Yeah. So you have to keep it in for 10 years to get the full protection there. The 7 years had to do with the step up. Yeah, but 10 years for that tax-free event. And actually which is amazing, right?
Right.
But of course, again, you understand this, and I'm sure most investors do, but it's always got to be about the fund or the deal or the projects or the operator first, right? I mean, all this is great, but if you invest in something, a poor investment, obviously, you're locked up for 10 years and you come out the back end, you lost money. It's like, well, okay.
Right.
Same write-off you'd get if you'd lost money somewhere else. So that doesn't help you. So yeah, that's really the main advantage, is I think is that third one. And we kind of look at that and say, well, so do you have to sell it at 10 years? And the answer is no. You actually could continue it and continue to grow that tax-free. And so our goal is to do well enough for our investors that we get to the end of the 10 years and we don't want to sell these. Ferd, once you get these and get them up to operating well and running efficiently, they're hard to go out and replace, right? I mean, if you sell it, like, what are you going to buy? Exactly. And so we feel like if we can do a good job and return investors' capital to them through the kind of the first 10 years of the fund, and then after that, they continue to get distributions. We don't want to sell, and we don't think our investors want to sell either, because it continues to grow tax-free.
No, that's great. That's definitely a niche. You're combining a couple different asset class niches. That's great. What kind of financing do you guys get on the front end? Are you looking at agency loans, just like if you're not in a fund, or does the fund complicate that you're not maybe you are a guarantor, but generally is you're not one person. Like if I go get a deal myself, I'm a guarantor. It's pretty clear I'm the decision maker, but you're the CEO, you're decision maker, but you got a whole flank of people around you. How does that complicate it?
Ferd, if I could get some of these guys here in the office to sign on those loans, I would love to do that. Nobody seems to be willing to do that, though. I don't know what the deal is. Maybe I'm not paying them enough. I don't know. Yeah, no. At the end of the day, the bank, right? Because what we're buying value add, right? We're buying the same stuff. I know that you buy in your business because there's the opportunity to improve it and increase revenue. And so it's, yeah, they're looking for a guarantor. And even though we have this fund structure, each of the, I don't want to dive into this too much, but each of the assets we buy has their own single purpose SPE, LLC. And then, yeah, if it's recourse debt, which it almost always is, then I get to.
You're signing the note then, yeah, okay. Yeah, I don't know if when you're getting the portfolio, I know normally if it's quote destabilized under 80% occupancy, for example, you're pretty much in recourse debt land, and if that's why it's like you got to have a big signature to get 5, 10, 15 parks at a time, or you got to have a really good banking relationship or some combination. So you're probably buying these with local regional banks, and then ideally towards the end of the fund original term, you'll refinance with agency loans and take the chips off the table and just ride them into the sunset. Is that kind of the business plan?
Yeah, and just like, when we buy a single asset or whatever, we don't want to wait 10 years to do it. We want to,
as soon as you can.
Exactly.
As soon as you can, yeah, absolutely. I was just thinking the 10 years, you're gonna hold them for a long time beyond the 10 years of your OZ fund, but you won't be on the same note. Yeah, obviously, you're gonna want to get those refinanced like anybody, right? As soon as you can. So spit the hook on that note, get the return investor capital, everybody wins. And then agency debt being so lucrative, at least today, relative to local banks, everything seems to be going well in the industry. I feel like the COVID era is making the industry better. And what are your thoughts on macro level, where we're at as an industry and where we're going?
Yeah, I know it's a good question. I don't know that I know any more than anybody else, but just based on what I'm seeing, it's amazing how much interest in the space. I mean, we get calls, and I'm sure you've experienced this as well, but just every week, people reaching out, wanting to buy what we have already, and definitely pretty competitive when we're out, trying to buy deals. It kind of reminds me of this portfolio we closed last week. It was about 900 pads, and there's actually another 200 of them that close. I think I was telling you next week, the one in Iowa. We put those in escrow a year ago.
Wow.
And there's just been, I'm not going to get into all the disruptions, but COVID was certainly part of it. And the question that would come up with our investors kind of right after COVID hit is like, hey, are we going to get some post-COVID pricing on this portfolio, right? Because I mean, it's like you look around, like real estate, right? I mean,
you're going the other way.
I know, and that's the thing. And they're like, now we look like geniuses, like putting this thing in escrow before COVID, because I don't know if you saw that one report indicating that across the board, MH values had gone up like 23% through COVID.
I don't doubt it. I mean,
so I don't know what's going on exactly. It's, I mean, I think it's generally getting pretty expensive, certainly for stabilized properties. But that's where, to me, I mean, we jumped into it. We felt like when we jumped in 2017, the only thing that made sense was value add. And I think that's more true now than ever, right? For a couple of reasons. One of them is, well, hey, if you fix that value add, like your exit looks even better than it did. And the other thing, even though cap rates have compressed across the spectrum of MH, if you think about it, if you're buying generally something that's half occupied, your cap is on your income on the 50%. So what about those other 50% that aren't occupied? Well, you're not paying a premium on those. Right. So we feel like, the prices have gone up a little bit on the value add, and there has been cap rate compression, but the exit looks much better than it did before, number one. And whether that's, selling to a bigger player or, our preferred exit, which is going to Fannie and Freddie. And so that looks even better. And then you're, like you said, you're not paying any premium on those unoccupied lots. So that's how we look at it.
Sounds like good stuff, man. I agree. I don't have any better wisdom than that. Before we part, what other tips or tactics do you have for people trying to, you've obviously been in the space for a few, like really only a few years, 3 or 4, but you've done 10, 15, 20 years of work in 3 years. What about the guys getting in for their first or second park? How do you, or maybe somebody medium sized trying to go to the fund level like you are, do you have any tips or tactics other than what we've already covered?
Yeah, I think one thing we found that our investors appreciate, and I think has helped us to grow our network of investors, is communication. So for example, when COVID hit, there was a lot of concern. I mean, we were concerned, right? As operators, we're like, man, I hope our folks can pay their rent. Investors being even that much more removed, they were concerned because, a lot of times if they've invested with us in MH, they've probably done a retail deal. They've done, some other things out there. And they're like, man, we got to, everything's suspended with our retail investment, or whatever. I mean, there's just concern. And so we made a decision. We're like, you know what? I think our investors want to hear from us a lot. Like they want to hear from us frequently. So, we were doing the quarterly reports and we were doing these investor calls and different things, but we made a decision. We're going to send out an email every week and we're going to track our delinquencies. And we're going to just kind of real time, hey, closed it yesterday. Here's what it looks like. Here's what it looks like month over month through the whole year. And so they can just kind of get that real time, basically feedback and data to know how our collections are doing. So I think that's one thing that the response that I've received is that a lot of people feel like they don't get that much communication from the sponsor, and especially if it's not good news, right? That they're not going to hear about it. I'd like to say our collections have been amazing, and we've done well, but it's not all smooth, and it's taken a lot of work, and it's taken a lot of extra effort that we didn't have to put in before. But I think just kind of sharing that information, people seem to appreciate that. And then, that turns it, I mean, here I am, we get a lot of referrals and I'm like, wow, that's awesome. Especially when I realized the person that invested with us hasn't received a penny from us yet, right? In many cases, all they know is, hey, it was a good experience onboarding. We're getting good communication. And it looks like we're headed in the right direction, right? And they're recommending us. And not all. I mean, some investors certainly have had longer, and it's a different experience. But we've gained. We actually had a review yesterday with CrowdStreet. We've gained something like almost 400 400 people in our database in the last 12 months. Wow. And we probably gained, I'm trying to remember that number, but it's over 100 new investors in the last 12 months as well. So yeah, that'd be the communication.
Great. So I've never heard of anybody doing weekly. That's great. We do monthly, and I thought that was good. I'm an investor in another fund, and I get a K1 most of the time on time, and that is it. And I'm like, you guys are breaking all kinds of rules in the operating agreement. If I had more time, I'd be more argumentative, but I'm just like, oh, it's like, it feels like it's a sunk cost with these guys. It's like, that's great that you're going, and investors hate that. And then a couple of investors are trying to round up a fight to sue these guys or take over. I like my hair. I don't want to lose it, doing that.
Yeah. Understood. Yeah.
Well, this is great. Anything else you want to share? And I want to get if you want to share your contact information or information your fund, tell us where we can find you.
Yeah, awesome, Ferd. Hey, by the way, really appreciate you having me on, and enjoyed our discussion. So you can, I'm on LinkedIn. I love LinkedIn. And so you can find me there, Sam Hales at Saratoga Group on LinkedIn. Our website is saratogagroup.com. And you'll find on there our offerings. Right now, we just have our Opportunity Zone Fund, and you can also go directly to that invest.saratogagroup.com. That's how to reach us.
All right, sounds good. Appreciate it, Sam. Thank you.
Okay, Ferd. Hey, thanks so much.
Got it. Bye now.